Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chris Englebert, Founding Partner and Chief Investment Officer with Englebert Financial Advisors, to discuss how RIAs should talk to their clients about earnings, a recession, and what inflation means to their portfolios. Chris, it's great to see you as always. Welcome back to Trade Talks.
Hey, Jill, thanks for having me. Yeah, you're right. We've been doing numerous client meetings after the first of the year. And really what's on top of everybody's minds is those big, three big items, earnings, what's going to happen this year with companies and their earnings. Right now we're in the midst of earnings week and we've had some hits and misses so far. But, then people are like, hey, what's going to go on, with a recession? Are we having a recession? This has got to be probably one of the most telegraphed recessions I've ever seen in my career. And then finally, people are really asking the question, is inflation dead? Has the Fed done enough or not? They're seeing some, prices come down in certain areas. But again, for example, still at the grocery store, prices are still high. So again, this overriding concern about, a lot of market pundits were out there in the fourth quarter going, gee, the fourth quarter earnings are really going to be bad. And we've seen a pretty significant rally in the equity indexes, and these earnings are not dropping off the cliff that everybody's, projecting. And again, like I said, as far as a recession goes, we've had a blowout jobs number much higher than what anybody expected. So it's really hard to get in that recession camp, at least for the first half of the year. I mean, a lot of people heard about the big tech companies laying people off, but then you turn around and see the jobs numbers we had. And again, the economy is still rolling along. And then, like I said, to wrap up with the inflation comment, we're seeing some easing. We are very fortunate that we've had a very warm winter, so to speak, at least in the eastern part of the country, but natural gas prices has plummeted. And so we should see some relief on the inflation side going forward for at least the next 6 months.
Yeah, I think part of the issue is not only are markets confused, but clients are confused because, to your point, we have an unemployment number we haven't seen since 1969, right? People are working and the market's moving higher, right? You would think that everyone out there saying, oh, there's going to be a recession and the Fed's continuing to raise rates, that might not necessarily be the way you would expect the market to play out, but that's in fact why it is. So it's really hard to discuss recession and inflation with clients in their portfolios when they've seen the market move up 10% in just 1 month. So it's got to be challenging as an advisor to kind of keep them in check. Meanwhile, FOMO always plays into this.
Yeah, and that goes into what, we have to do as an RIA. I mean, you and I have talked about this previously, and especially last year when it was so challenging. You had equities down, you had bonds down as much as equities, and you had a lot of clients wanting to abandon their long-term investment strategy and just sit on the sidelines. Well, we did a tremendous amount of hand-holding. We said, don't do that, because sure enough, literally in the last 4.5 weeks, we've seen a major rebound in the equity averages, and the bond market has done extremely well too. So if anybody made a radical change to get out, in September, which would have been disastrous, they would have missed the ensuing rallies that we've had so far. And again, stick with your long-term investment strategy. There's going to be times when it's challenging, but then you get the other side of the coin. And we've been saying the last couple of months, we thought the surprise is on the upside. And so far it has been, it's been positive.
Yeah, let's take a look at a couple of the charts here. We'll start with the S&P 500, of course, with one of its best starts to the year.
Yeah, no question about it. Now, there's some very interesting things happening. There was the mother of all downtrend lines that have been broken. We are now getting some more technical aspects that are queuing up. The 50-day moving average is crossing above the 200-day moving average, which a lot of the technicians are yelling it's what they call a golden cross. Now, longer term, that's more positive, but short term, we feel the markets have gone so far, so fast. I would not be surprised to see a short-term breather. But again, we're getting a much more constructive picture than obviously we had last year.
And Chris, if we take a look at the Nasdaq, of course, what led the way during the recovery also leads the way during the sell-off, and now leading the way again as we've seen this rally.
Yeah, and this just goes to show you, obviously, large cap growth is extremely volatile. Down over 30% last year with the Nasdaq, but now up to almost 16%. This year, what we feel happened is that a lot of these stocks led this whole recession, layoff, corporate earnings are going to be disastrous themes. And now they're coming out and earnings may not be good, but they're not disastrous, number one. Number two, there looks to be a large rebalancing trade going on out there in the equity sector where, many large pension funds, got way overweighted value dividend stocks and way underweighted, and they have a mandate. They have to kind of, stay down the middle of the road. So a lot of money beginning in the middle of December, we saw flows coming back into large cap growth. And obviously it's paid off for investors so far this year.
Right. And of course, let's take a look at the Russell 2000 because small caps are prime for this market environment.
Yeah, I've been a cheerleader in this section for the last 16 months. It's starting off extremely well this year. Again, if you look at the valuation levels of, the Russell 2000 or small mid-cap stocks versus large cap, there was recently a money manager put out a great white paper showing exactly what happened with the Nifty 50 in the 70s, how everybody crowded into that trade. And he drew some very good parallels to what's happening here with the FANG stocks. Now, again, you have the last couple of weeks where large cap growth has really rebounded well, but the relative strength in our models just traded the other day, and their models are confirming that the relative strength is still in the small mid-cap area so far for 2023.
And how about oil? I mean, you mentioned earlier at the top that energy is having, despite as cold as it has been, natural gas is so regional. It really is interesting. But what about oil? How's that trading?
Yeah, I mean, oil is having a tough time holding above $80 a barrel. You can see this long-term downtrend line. It rallied back up to it. And the real question is whether or not oil is going to be able to hold in the 70 sector, $70 price range. Because I think if it loses $70 a barrel, you could quick see a move to 40 or 50, which would be a huge relief again to the consumers out there. But again, the story here is this isn't really a recessionary trade. This is a trade where there's plenty. Again, commodities tend to be self-correcting. What we mean by that is higher prices produce more supplies, and eventually that surplus catches up. And we think that's what's happening in the oil market and the natural gas market.
And finally, Chris, let's wrap up with the 10-year.
Yeah, everybody's been watching the Fed. They did raise this week a quarter basis point on the short end. But you can see, back in November, there was a large spike to 450 on the 10-year Treasury. It seems to be settling around, finding its home, so to speak, right around the 350 level, 3.5% level. Important chart pattern here is that, if interest rates dip below 345, you could see a quick move down to 3.25 or 3%. Now, does that forecast recession in the back half of the year? I don't know, but my view this year is that interest rates, after the tremendous move that they have had last year, tend to kind of go to sleep this year, and we could be plus or minus 50 basis points right from this level, around 3.5% for the rest of the year.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.